So what exactly are we looking at right now? Is this the birth of a whole new technological age, or are we just watching the biggest financial bubble in a generation inflate right in front of our eyes? That really is the billion, or maybe even trillion-dollar question around this whole AI boom. Okay, let's get into it.
Here's how we're going to break this down. First, we'll look at the incredible gold rush of cash that's fueling all of this. Then we're going to tune into those whispers of a bubble coming from market analysts. We'll also explore a completely different, more cautious strategy, see how it all fits into the bigger picture of the market, and finally, try to land on an answer to that big question. Is this all just frenzy, or is it really the future?
All right, first things first. To really get a handle on what's happening, you have to appreciate the sheer volume of money being poured into artificial intelligence. I mean, the numbers are absolutely staggering.
And look, we are not talking about small bets here. You've got industry giants making these colossal commitments. Take Anthropic, a huge AI research company. They're planning to spend a cool $50 billion, and yes, that's billion with a B, just on building the essential data centers, the massive computing powerhouses you need to run these complex models.
And this flood of cash isn't just for the big, established players. Nope. Startups are rocketing to these astronomical valuations almost overnight. Just look at the AI coding assistant, Cursor. Its valuation has just exploded, reaching into the tens of billions, at least on paper.
So, how did they get there? That's the really wild part. A single funding round of over $2 billion just about tripled the company's value in a matter of months. That just screams investor appetite, right? It's this intense fear of missing out that's just driving capital into the sector at a breakneck pace.
And don't for a second think this is just a Silicon Valley story. Oh no, it is a full-blown global race. Over in China, you've got giants like Baidu and Alibaba furiously revamping their AI models, pushing hard to keep pace and compete on the world stage.
Now, wherever you find this much money moving this fast, you are also going to find people getting worried about a bubble. So let's take a look at the warning signs that are starting to flash.
And this quote right here, it just nails the heart of the concern. We're seeing analysts issue these very direct warnings about AI exuberance. This particular analyst, one of the few, by the way, with sell ratings on major chip makers, he basically believes stock prices have soared so high they've become totally disconnected from their underlying value.
So, the crucial point is this widening gap. On one side, you have what analysts call frothy valuations, which is just fancy talk for prices driven by pure hype and a story about the future. But on the other side, you've got sluggish earnings delivery, where the actual profits just aren't matching all that excitement. That disconnect is a classic, textbook characteristic of a bubble.
But is this all-in, high-spending frenzy the only way to play the AI game? Well, not everyone thinks so. Some companies are choosing a very different, much more measured path.
This table lays out the two main camps that are forming. In one corner, you have the splashy AI bets, companies going all in, building new infrastructure for a market they hope is going to materialize. And in the other corner, you have the steady growth approach. Think a company like Tencent, which is focused on its existing, profitable businesses and carefully integrating AI to serve the customers it already has.
And what's really fascinating is that some investors are actively seeking shelter in what they see as a safer bet. They're rewarding Tencent's steady, proven performance because it's based on actual profits today, not some speculative promise of tomorrow. It's like a flight to quality, amid fears that the AI hype might just be getting ahead of itself.
And this nervousness isn't just isolated to AI stocks. In fact, when you zoom out and look at the whole financial landscape, you see similar signs of caution popping up everywhere.
The U.S. stock rally is being described as fragile. Japan is worried about a crypto hoarding frenzy. Even Bitcoin is struggling because the big buyers are retreating. But that last point is really telling. Even the debt markets are becoming nervous. Investors are becoming more cautious about funding the very data centers the AI boom depends on. That means the skepticism is hitting the literal nuts and bolts of the revolution.
Okay, so we've seen the massive investment, the bubble warnings, the alternate strategies, and the broader market anxiety. How in the world do we weigh these completely conflicting signals?
Well, the bull case is pretty clear. The sheer scale of the capital and the frantic pace of innovation. They're powerful arguments that this isn't just hype. This is the foundation of a new technological revolution, a genuinely transformative moment.
But the bear case is just as compelling.
When you hear phrases like unjustifiable valuations and sluggish earnings from sober-minded analysts, and you pair that with fragility in the wider market, well, it's impossible to ignore the echoes of past speculative bubbles.
So we're left with a market that is fundamentally divided. Are we simply at the peak of a classic hype cycle, destined for a painful correction? Or are we truly witnessing the messy, expensive, but ultimately world-changing birth of a new reality? Right now, that remains the most important question in tech and in finance.